Welcome to the Tesla Daily News Podcast. I'm glad you're here. Today is March 23rd, 2026, and we're breaking down the Tesla headlines that actually matter for investors. Musk's bold new chip manufacturing push, a fresh regulatory escalation on full self-driving, competitive pressure building in the US EV market, and what today's macro backdrop could mean for Tesla. Story 1: Tesla and SpaceX go vertical on chips with Terafab, and it's a giant swing. Here's the hook. Elon Musk just unveiled plans for Terafab near Austin, a project he claims could become the largest chip manufacturing facility ever. Context: Tesla's long-term bull thesis is increasingly about autonomy, robotics, and AI, and those businesses live or die on compute. If Tesla can't secure enough chips, it can't scale Cybercab robotics, it can't scale Optimus, and it can't keep improving full self-driving at the pace investors are pricing in. Details: multiple reports say Terafab will be jointly run by Tesla and SpaceX, with xAI also tied in. The stated target is massive, chips supporting 100 to 200 gigawatts of computing power per year on Earth, plus an eventual 1 terawatt target for space compute. Several outlets peg the upfront cost around $20 to $25 billion, and Musk has referenced advanced nodes like 2 nanometers. He's also been explicit that this is not an immediate NVIDIA replacement. Tesla expects to keep buying third-party chips while Terafab is built. Impact: for Tesla, this is a classic trade-off: strategic control versus capital intensity. On the positive side, investors could read this as Tesla taking supply risk off the table and doubling down on the AI company narrative, vertical integration from chip to robot to vehicle. On the negative side, semiconductor manufacturing is brutally hard, lead times are long, and execution risk is real. Even optimistic timelines still put meaningful output years away. The market will watch for 3 proof points: an actual site and groundbreaking, a credible equipment and process roadmap, and clarity on how Tesla funds it, through cash flow, debt, or dilution. Takeaway: Terafab is not a near-term earnings catalyst. It's a long-horizon bet that could reshape Tesla's cost structure and strategic moat, or become a very expensive distraction if timelines slip. Story 2: regulators just escalated scrutiny of full self-driving in low-visibility conditions. The hook: the National Highway Traffic Safety Administration has upgraded its probe into Tesla's full self-driving, supervised system, moving into an engineering analysis, which is the agency's highest level of investigation before a potential recall request. Context: FSD progress is one of the biggest valuation levers for Tesla. But every step toward wider adoption also increases the regulatory and reputational exposure. When you see an investigation move up a notch, the market often prices in more headline risk, even before any outcome is announced. Details: the focus here is performance in low-visibility conditions. Think fog, heavy rain, glare, or other scenarios where sensors and perception can struggle. An engineering analysis typically means NHTSA believes the issue is substantial enough to warrant deeper technical review, data requests, and potential remedies. Impact: in the short run, this can pressure sentiment because it reintroduces recall risk and slows the narrative momentum around autonomy. In the longer run, a clean outcome, or a fix that can be delivered via software, can be manageable. But if regulators push for changes that meaningfully restrict use cases, it can hit the robotaxi optionality premium investors assign to Tesla. Takeaway: watch for any Tesla software update notes tied to low-visibility behavior, any changes to driver monitoring, and whether the investigation expands to additional scenarios or incidents. Story 3: a real-world FSD crash story, highlights the supervision trap debate. The hook: a widely shared account from a former autonomous driving executive describes a crash involving Tesla's full self-driving, supervised, even while the driver says he followed Tesla's guidance. Context: the core challenge with level 2 systems is human factors. If the system is good enough that people relax, but not good enough to handle edge cases, the gap becomes reaction time, and that's where accidents happen. Details: the argument being made is that near-flawless performance can reduce driver engagement, making it harder to respond quickly when the system fails. That's not just a Tesla issue, it's a structural risk of supervised autonomy. Impact: these stories don't usually move the stock by themselves, but they feed into the regulatory climate, consumer trust, and potential insurance dynamics. They also matter to institutional investors because they shape the probability-weighted timeline to unsupervised autonomy. Takeaway: for Tesla watchers, the key isn't a single incident, it's the pattern. If the public narrative shifts from FSD is improving fast to FSD is creating new kinds of risk, valuation multiples can compress. Story 4: competition. Tesla still dominates the US EV market, but the Model Y is becoming a single-point pressure target. The Hook, a new competitive read, argues Tesla still controls more than half of the US EV market, but the competitive fight is increasingly aimed at one vehicle, the Model Y. Context: investors care about concentration risk. If one model drives the majority of unit volume, then pricing pressure or demand softness in that segment can hit revenue and gross margin quickly. Details: the report cites last year's shipments at 418,000 vehicles, with roughly 406,000 being Model 3 or Model Y, and more than 350,000 of that being Model Y alone, or over 80% of Tesla's unit volume in 2025. It also points to Rivian's upcoming R2 SUV as a major near-term competitor under $50,000, with additional R3 and R3X models expected later. At the same time, legacy automakers like Ford and GM are described as scaling back EV investment due to losses, which could reduce the number of serious Model Y challengers from the traditional incumbents. Impact: the market takeaway is mixed. More pure-play competition can pressure pricing. But if large incumbents retreat, Tesla can keep share and preserve scale advantages, especially if it keeps manufacturing costs down. Takeaway: if you're tracking Tesla into the next quarters, watch for Model Y demand signals, pricing actions, incentive trends, and whether rivals can actually deliver volume, not just reveal concepts. Story 5. Magnificent 7 Dynamics. The correlation with the S&P 500 is breaking. The Hook. Bloomberg reports the relationship between the Magnificent 7 stocks and the broader S&P 500 has shifted in an unusual way. Context: Tesla trades like a mega-cap tech name in many portfolios. When the mega-cap tech trade is under pressure or rotates, Tesla often moves with it regardless of company-specific news. Details: the piece notes Tesla is part of the Magnificent 7 alongside Nvidia, Apple, Microsoft, Alphabet, Amazon, and Meta, and it frames the current environment as one where the historical lockstep with the index is weakening. Impact: for traders, this matters because it changes the beta story. Tesla may get more idiosyncratic again, meaning company-specific catalysts like autonomy, margins, and capex could drive relative performance more than index flows. Takeaway: if you're trading Tesla, pay attention to whether Tesla is moving with tech or decoupling. That can change the effectiveness of hedges and the read-through from macro headlines. Story 6. Macro and risk-off. Energy shocks and market volatility are back in the frame. The Hook. Multiple market reports are pointing to sustained volatility tied to geopolitical conflict and a spike in oil and gasoline prices. Context: higher oil can help EV demand at the margin, but in practice, sharp energy spikes often come with higher rates, risk-off behavior, and pressure on consumer discretionary spending, which can hurt auto demand and compress multiples. Details: one market recap cites Brent crude around $112 a barrel and U.S. gasoline near $3.93 a gallon, alongside rising yields. In that environment, growth stocks can re-rate lower. Impact: Tesla sits at an intersection. It benefits from the EV narrative when gas prices rise, but it also suffers when financing costs rise and the market de-risks. Takeaway: watch rates, credit conditions, and Tesla's pricing power. If the macro tape stays ugly, even good Tesla headlines can struggle to lift the stock. That's it for today. Quick recap: Terafab is a massive strategic bet that could strengthen Tesla's AI and robotics moat but raises capex and execution risk. Regulators have escalated scrutiny of full self-driving in low-visibility conditions, which can weigh on autonomy sentiment. Competition is tightening around Model Y, and the macro backdrop remains volatile. For tomorrow, keep an eye on any follow-up details about Terafab financing and timelines, plus any Tesla or NHTSA updates tied to the FSD engineering analysis. If you found this useful, subscribe to the Tesla Daily News podcast and follow for daily, investor-focused Tesla updates.